this week brought a shift in momentum for U.S. markets, as the S&P 500 and Dow Jones Industrial Average saw declines of around 1% and 3%, respectively, snapping a 6-week streak of gains. While these major indices faltered, the NASDAQ Composite edged upward, achieving its 7th consecutive week of gains. The NASDAQ's rise was buoyed by strong performances from technology stocks, briefly touching an intraday all-time high on Friday. However, it closed just shy of breaking its prior record, ending the week 0.7% below the peak set a few months ago. Meanwhile, the S&P 500 has remained largely in record territory since mid-September, holding firm despite recent shifts. Amid these market movements, investors are keeping a cautious eye on inflation, as seen in the 10-year U.S. Treasury yield climbing for the 5th time in 6 weeks. The yield closed Friday at 4.24%, up from 4.07% the previous week and significantly above its recent low of 3.62% in mid-September. This upward pressure on yields reflects a tempered outlook on inflation and continued speculation around the Federal Reserve's future rate cuts. Earnings season is in full swing, with large-cap technology stocks, often referred to as the Magnificent Seven, expected to carry much of the earnings growth for the S&P 500. Analysts predict that these companies will post an average earnings growth of 18.1% for the third quarter, starkly outpacing the remaining 493 companies in the index, which are collectively expected to report a near-flat growth of 0.1%. These mega-cap tech firms continue to have a disproportionate impact on the broader market's overall performance, emphasizing their influence in a mixed earnings landscape. On the consumer front, confidence levels are on the rise. The University of Michigan's Consumer Sentiment Index closed October with a reading of 70.5, up from a preliminary 68.9 reported earlier in the month. This marks a 6-month high and the third straight month of increases, suggesting that consumers may be feeling more optimistic even as inflation and other pressures linger. The housing market, however, is showing continued signs of strain. The National Association of Realtors reported that sales of previously owned homes dropped by 1% in September compared to the prior month, a decrease of over 3.5% from the same period last year. This dip underscores ongoing challenges in affordability and inventory, as higher interest rates have made home ownership less attainable for many buyers. In commodities, U.S. crude oil prices rebounded this week, climbing nearly 5% to close at about $72 per barrel on Friday. This gain, however, was insufficient to offset the prior week's significant decline of more than 8%, and oil prices remain well below the recent high of $83 reached in early July, a sign of continued volatility in energy markets. Looking ahead, investors will be watching closely as the U.S. government releases its preliminary third-quarter GDP estimate on Wednesday. This report will provide insights into the pace of economic growth heading into year-end. Additionally, October's monthly jobs report, due Friday, will reveal whether hiring continued at the brisk pace seen in September, when the U.S. economy added 254,000 jobs, the highest gain in 6 months. These economic indicators are likely to shape market sentiment and potentially influence Federal Reserve policy considerations in the coming weeks.